Welcome to House Lux Estate, your trusted source for all things real estate and finance related. Our mission is to provide you with the tools you need to make informed decisions. Today, we're focusing on a topic that's crucial for every small business owner: reducing tax liability legally. We'll explore strategies that can help you retain more of your hard-earned income, all while staying within the bounds of the law. So, buckle up as we dive into the world of tax strategies and savings. Before we delve into reducing tax liability, it's crucial to understand what tax liability exactly is. In simple terms, tax liability refers to the total amount of tax debt owed by an individual, corporation, or other entity to the tax authorities. For small businesses, this includes federal, state, and local taxes. Now, why is understanding tax liability so important for small businesses? Well, it's simple. It's about financial health. Knowing your tax liability allows you to budget appropriately. It ensures you don't get caught off guard by a hefty tax bill, potentially disrupting your cash flow and causing financial stress. Moreover, understanding your tax liability can provide valuable insights into your business's profitability. After all, the more profit you make, the more taxes you generally owe. So, a higher tax liability might not be all bad news. It could be indicative of a thriving business. However, if not handled properly, tax liability can have serious financial consequences. Late payment of taxes can result in penalties and interest. In severe cases, it can even lead to legal issues or bankruptcy. So to sum up, tax liability is not just another line item on your financial statements. It's a vital aspect of your business's financial health and needs to be managed with due diligence. Now that we've grasped the concept of tax liability, let's explore the ways to reduce it. Reducing tax liability starts with effective planning and understanding of tax laws. Now, this might seem a bit daunting, but don't worry, we're here to guide you through it. Firstly, let's talk about record keeping. Accurate and consistent record keeping is the cornerstone of any successful tax strategy. It's not just about keeping every receipt and invoice, but rather about maintaining a systematic and organized manner of record keeping. This is crucial because it allows you to track your income and expenses effectively. Also, it provides a clear picture of your financial situation, which is essential when it comes to tax planning. Remember, you can't plan for a tax bill you can't see coming. Now, you might be thinking, but I'm a small business owner, not an accountant. And that's where our next tip comes in. Consider hiring a tax professional. Yes, it might seem like an added expense, but hear us out. A tax professional can help you navigate the intricate labyrinth of tax laws, identify potential tax deductions and credits, and even represent you in case of an audit. They can guide you on how to structure your business in a way that's most beneficial for you tax-wise and keep you updated on the latest changes in tax laws. Additionally, a tax professional can help ensure timely tax filing. And this is important because late filing can lead to penalties, which can increase your tax liability. Timeliness also applies to paying your taxes. Remember, the sooner you pay, the less interest and penalties you accrue. So, to recap, accurate record keeping and timely tax filing are fundamental strategies to reduce tax liability, and hiring a tax professional can provide expert guidance and peace of mind. These strategies not only help you stay on the right side of the law, but also help you keep more of your hard-earned money. But that's not all. There are more strategies we can employ. So stay tuned as we dive deeper into the world of taxes and explore more ways to legally reduce your tax liability. Smart business decisions can also contribute significantly towards reducing your tax liability. Let's delve into another set of strategies that involve understanding tax deductions and credits and the concept of shifting income or expenses to different tax years. First, tax deductions. These are expenses you incur that can be subtracted from your taxable income. Think of it like a discount on your income tax. Common deductions for small businesses include home office expenses, travel costs, and advertising expenses. The trick is to stay informed about what qualifies as a tax deduction in your specific industry and location, and to keep meticulous records of these expenses. Next, tax credits. These are even more valuable than deductions because they reduce your tax bill dollar for dollar. That's right, for every dollar of tax credit, you pay $1 less in taxes. Some common tax credits for businesses include the Work Opportunity Tax Credit for hiring individuals from certain target groups, and the Research and Experimentation Tax Credit for businesses that engage in qualifying research activities. Now let's talk about shifting income or expenses to different tax years. This strategy involves timing your income and expenses strategically to take advantage of the tax laws in place during different tax years. For instance, if you expect to be in a lower tax bracket next year, you might want to defer some of this year's income to next year. Conversely, if you anticipate a higher tax rate next year, you could accelerate income into this year and delay expenses to next year. Remember, all these strategies need to be implemented with a clear understanding of the tax laws and regulations. It's always a good idea to seek advice from a tax professional to avoid any potential pitfalls. The road to reduced tax liability is paved with informed decision-making, and keeping yourself informed is the first step towards making those smart business decisions that will help you keep more of your hard-earned money in your pocket. While reducing tax liability is beneficial, it's paramount to do it legally. Now that's a statement that should be etched in the minds of every business owner. Yes, we've been talking about strategies to reduce tax liability, but it's equally important to understand the legal framework that governs these strategies. You see, taxes aren't just a necessary evil, they're a civic responsibility. They fund the public services we all rely on, from infrastructure to education. So, while it's smart to minimize your tax liability where possible, it's crucial to do so within the bounds of the law. Let's get this straight. Tax evasion is a crime. It's the illegal act of not paying taxes by not reporting all income or by inflating expenses. If caught, the penalties can be severe, including hefty fines and even jail time. On the other hand, tax avoidance is entirely legal. It involves using the tax code to your advantage to reduce your tax liability. The tax code is complex and full of provisions designed to encourage certain behaviors, like investing in retirement savings or purchasing equipment for your business. But here's the catch. The line between tax avoidance and tax evasion can be blurry. What may seem like a clever strategy to one person could be viewed as fraudulent by another, especially if the tax authorities get involved. To navigate this complex landscape, it's recommended to consult with a tax professional. They can help you understand the nuances of the tax code, identify legal tax reduction strategies, and ensure you're in compliance with all relevant laws and regulations. Remember, the goal is not just to reduce your tax burden, but to do so in a way that's ethical and responsible. Don't be tempted by quick-fix solutions that promise to drastically cut your taxes without any legal basis. Reducing tax liability legally is not just smart, it's the right thing to do. So let's continue to explore ways to keep more of your hard-earned money, but always with an eye on the law. Let's recap the essential points we've discussed today. We began by demystifying tax liability, explaining it as the total amount of tax debt owed by an individual, corporation, or other entity to a taxing authority. It's not just about numbers on a page, it's about understanding the economic effects of taxation on your small business and how to navigate them. We then moved on to strategies for reducing tax liability, starting with the importance of keeping accurate records. Remember, a well-organized bookkeeping system is your best friend when it comes to managing your taxes. It can help you claim all the deductions you're entitled to and avoid costly mistakes. We also highlighted the value of exploring tax credits, from energy efficiency incentives to R&D credits. These can significantly lower your tax bill if you qualify. And don't forget about Section 179 deductions, which allow you to write off the full cost of qualifying business equipment in the year it's purchased. In Part 2 of our strategies, we looked at the benefits of hiring an accountant or tax advisor. These professionals can provide personalized advice based on your business's unique circumstances and keep you updated on the latest tax laws and regulations. Another key strategy we discussed was making the most of retirement plans and health savings accounts. Contributions to these plans are often tax deductible, providing another avenue to reduce your taxable income. Lastly, we delved into some legal considerations. It's crucial to remember that while it's perfectly legal to minimize your tax burden using the strategies we've discussed, evading taxes is a serious crime with severe penalties. Thank you for joining us on House Lux Estate. We hope this information will prove valuable as you work to reduce your tax liability and boost your business's financial health. And remember, the journey to financial wisdom doesn't end here. Don't forget to subscribe for more insightful videos. Until next time, keep making smart financial decisions.